Welcome to the NZ Everyday Investor. I'm Darcy Ungaro, and I'm in the studio with Rupert Carlyon.
Hi.
Hey, how you doing?
Very well. How are you?
Very good. I'm happy to be here. I'm happy to be alive. It's a beautiful day outside.
It's a gorgeous day. Summer's come back. What more can we want?
Summer's never gone, man. It's amazing. It's been one of the best summers ever, eh?
Yeah.
Unless you need water.
Yeah, well, we're big water people.
Yeah.
A little bit less wind, a little bit more time on the water would have been nice, but
Yeah.
you can't moan too much.
Take what we get.
Exactly.
So, Rupert, we're going to have a chat today. Not a lot of scripting, no bullet points, no nothing, which is actually just the way I love it. Nice and real and authentic. We're going to talk about KiwiSaver.
Yep.
And we're talking about the problem, the current solutions, and what the ideal solution would be. Sound like a plan?
It sounds good. Sounds great.
Perfect. So for our listeners, so they know who you are, tell us, who the heck are you? What makes you into what you do?
Cool. So I'm Rupert Carlyon. I'm the MD of Koura Wealth. We are a brand new KiwiSaver scheme that started up in October last year.
Yeah.
We trying to change the way people think about their KiwiSaver. We're trying to help people make better KiwiSaver decisions. And we're doing that because we were one of the first people to launch a digital advisor, which kind of helps people make an assessment of their objectives, their risk appetite, and gives some recommendations. One of the big issues in KiwiSaver at the moment is people aren't making the right decisions. And I think a core reason for that is people aren't getting enough help to make those right decisions.
Got it. Okay. And why did you get into this? Like a little bit about your background and why you're here right now.
So a long time investment banking between Auckland and London. I left New Zealand back in 2008, just as KiwiSaver was starting. Yeah. Great time to go to London in the middle of a financial crisis. And kind of was fascinated, right? So when we left New Zealand, KiwiSaver was going to change the world, right?
Yeah. We
were going to make New Zealand a country of investors.
Yeah.
All of a sudden, people were going to understand the financial markets. We were going to have all these great products come out. And we were going to solve this retirement savings problem that we'd been talking about for such a long time.
Yeah.
Roll forward to 2014, I come back to New Zealand. Yeah. First thing I do when I get back is I ring up my KiwiSaver provider to say, hey, what can I do with my KiwiSaver? I'd come from the UK where I'd been used to managing my pension and kind of knew exactly what was happening, had a whole series of options.
Yeah.
And my provider said to me, you should just be in a growth fund. So, can I understand a little bit about that? Who are the people involved? What's the investment strategy? What are we doing here?
Yeah.
No, you've misunderstood, Rupert. This is KiwiSaver. Just put it in a growth fund, go away. Don't think about it. There's kind of nothing else to it.
Right. And this is you're actually speaking with the fund manager.
I was speaking with the client service people.
Yeah.
And that's they didn't say it in so many words, but that's pretty much what they said.
Yeah.
They had no interest in having a real conversation about it because in their mind, it's such a simple product that actually, why do I need to ask questions?
Wow. Okay.
It was amazing.
Because you probably would have been one of the ones that would have had high hopes, high expectations. And so when you go to test that and to validate that, you would have been let down quite a bit. That would have been quite a big marker in your mind, right?
Oh, it was massive, right? So I was a big investor in funds. I'd spent a lot of time on trading floors in the UK. And so for me, with my UK pension, for me to select where I wanted to put my money, because it's my hard-earned savings, I would kind of do quite a lot of research to understand, is this a fund manager I like the look of? Is this an investment strategy that I think kind of makes sense? What are the fees? There was kind of, every time before I made a decision, I'd be given pages and pages of information to go through. And so I was kind of shocked that actually, no one was asking these questions about where their money was going. And B, when I did ask the questions, I was told basically go away.
Wow. Okay. Okay.
So it's really hard, right?
Yeah. But what I guess you're implying here is that maybe the pathway that it started off on was wrong to start with, rather than it became outdated, right?
Well, I think the pathway that it started off in was great.
Yeah.
It just never evolved. So when it was small and kind of to get it started, it needed to be really simple.
Yeah.
But as you moved into a world where, and actually average balances were moving up into the $15,000-$20,000 range. You kind of all of a sudden people had started to see the success of the product. It kind of, I think at that point it was at about $30-40 billion product. And what you would typically expect to see as a market develops is innovation and change.
Sure.
And you didn't see any of that, right? I mean, all of the providers were still offering a growth balanced conservative option. I mean, these were kind of a little bit slightly analogous. I liken it to the iPhone, right?
Yeah.
This is a corporate structure that was built in 2007 before we even had an iPhone.
Yeah.
Come roll forward 2014, we're up to the iPhone 7.
Yeah.
But we haven't touched any of this stuff.
Right. Gotcha. And why do you think? So why do you think that there hasn't been that evolution, that innovation, that progression? Why do you think that is?
I think for 2 or 3 reasons, right? I think first and foremost, we need to look at the market structure. And we have got the market largely dominated by the top 5 players. So between the big banks and AMP, those guys have 75-80% market share.
Yeah.
And I think what we do know about the big banks is it's very, very rare that they innovate. Innovation is typically forced on them by losing market share, or regulators.
So innovation in their world is a response to disruption.
Exactly.
Right.
It's not something they'll proactively do.
Right.
And because we hadn't seen other people coming in disrupting and doing things differently, that means the products had never changed, right?
Sure.
And they had never needed to change.
Sure.
We had a default structure, a default fund structure, which kind of meant that the big players in the market were getting funneled lots and lots of customers without actually having to do anything. And so it was a nice, easy way of operating, and you didn't need to do anything different, right? Fundamentally, if you developed a better, different product, from a bank's perspective, what does it do for you?
Yeah.
It makes your life harder. But it doesn't actually do anything, right? Because you're unlikely to get many more customers. You're not going to make higher fees. You're actually going to push fees down.
Right.
And so where's the incentive, right?
Gotcha.
There's no incentive to innovate if you are one of those bigger players in the market.
Gotcha. So the fact that those people were dominating the space meant that there was almost like this suppression of innovation. Not because there was any sort of bad intent there, but it was just a function of who those players are.
I think it's a function of who they are, right?
Yeah.
And when you've got such a large piece dominating the market, it's also really hard to compete.
Sure.
Because you sit there as a young challenger. So when we started out and started thinking about our business, everyone said to us, but how are you going to get distribution? You can't compete with the banks. You can't compete with the banks. You'll never get distribution. How are you actually going to sell this product? And I mean, I had probably 20 or 30 conversations along those lines.
And that's a valid question, right? Like,
it's an amazing question.
Yeah.
I mean, we sat there and then went, and then luckily I was still a little bit naive and hopeful back then. So we kind of pushed through that. But when we did some market research before we launched, right? I mean, you've got the banks going out and giving, so 10% of bank customers that have a KiwiSaver that we surveyed, they've been given discounts on their mortgages to move their KiwiSaver.
Correct.
There've been discounts on all of their other products, right? And
or
so
they've been told that the discount is because of that.
Yeah.
Right?
But exactly, that's what they've been told.
Yeah.
And it's an inherent ecosystem that's really hard to break into.
Yes.
And so when you put the default structure, the infrastructure that the banks all have, it actually makes it really, really tough for challengers.
Yes. In a sense, it's kind of a form of an oligopoly, I guess you could say.
I wouldn't even say the word form.
Okay.
I mean, no, but banking sector here, the finance sector here it's the big four.
Yeah.
They can do whatever they want, and they will pick and choose where and how they play.
Yeah. And again, it's not because these people are necessarily evil.
No.
But it's just it's almost like a structural flaw because of what it is and the position that it currently is in. These are some of the outcomes, but it's not, I wouldn't suggest, and I don't think you disagree with this,
it's definitely not evil, right? I think it's definitely not that. What it is it's a structure of us being a small market.
Yeah.
So there's not a huge amount of room, and when you put 4 large players in a very small market, there's just not a huge amount of room for anyone else.
Yeah.
And I think you've also got to give the banks a bit of credit in that it's when you're as big as they are, it's really hard to innovate.
Yeah.
I mean, BNZ is a great example, right? They made some changes to their KiwiSaver product last year. But it was fascinating, kind of the press release, and they got a bit of flack around that because there were some internal emails that got shown by the media about the product not being very good.
Right.
And then it took them 12 months to change it.
Right.
The BNZ guys were extremely proud that they'd managed to make that change in 12 months.
Wow.
Because that was a great outcome for them, and that was a quick change.
Whereas as a small player, that would be like
3
next
weeks.
week done.
Yeah.
But that's the problem, right?
That's it, right?
With these big behemoths.
Yeah.
Hard to turn the ship.
And so that's it's the price we pay for having a small market.
And if you were a smaller player trying to break into that, the biggest thing that a smaller player doesn't have is the distribution, right?
Massive.
Like that's probably the number one issue.
Yep. Number one issue is distribution.
Yeah, because the regulation, setting it up, it's not actually rocket science. You just assemble a bunch of stuff, but it's getting your product to market. That's the biggest challenge you have, and that's the biggest advantage that the banks have. So obviously there are a lot of other small players. And I'm guessing the number one reason why a potential KiwiSaver member may or may not decide to go with that is largely because of brand, and they do, rightly or wrongly, trust the big bank brand, don't they?
Oh, and rightly so, right? The big banks have been operating for such a long time. They deserve trust, right?
Yeah.
You are always going to trust a bank over a young startup like a Koura. The issue, but it's kind of the beauty about the regulated world we live in is actually it's completely unfounded because we have the same regulatory frameworks as the big banks.
And for our listeners, and we have covered this before in the show, but just to really reiterate and explain how this works, if I'm a member of one, KiwiSaver, like AMP versus Craig's versus you guys, it's not like I'm actually investing in you.
No.
You're just the fund manager. You're making investment decisions on my behalf.
Yeah.
Talk me through that.
So for us, it's a really simple model, and it's completely segregated, right? So a KiwiSaver, go back to 101 on KiwiSaver. So you contribute through your employer, or most people do, apart from a voluntary contribution. Your employer will pay to the IRD. The IRD will pay the money to an administration provider. And there's one big administration provider which the entire market uses. Yeah. That money is put into a bank account which is held on trust by an independent supervisor. Okay. So the money never comes anywhere near Koura.
Yeah.
We then give instructions on how to invest that money, but it's completely independent from us. And what we do is actually, because we think the best outcome is leveraging global scale and leveraging kind of global products, we actually work and we invest all of our money into BlackRock products. So BlackRock, largest fund manager in the world. Yeah. What we're doing is all of our international stuff, we're going out and buying BlackRock global ETFs. Right. All got billions of dollars sitting in them. So it's actually, so you're not really trusting a startup with us.
No. Well, all you're really doing is you're trusting the business to make some decisions.
Exactly.
And the decisions aren't these opaque, behind closed doors, smoke and mirrors. You've just told me.
So no, exactly. And it's really simple, right? And so you're trusting us to make, exactly as you say, trusting us to make the right decisions. And then so you then, as an investor, you kind of go and look at the people, right? And go, actually, are these the people that you think can be making the right decisions for us?
Yeah.
And so that was one of the things I think when we set Koura up, we were adamant on making sure we had the right people involved, right?
Yeah.
So we've got Rupert Carlyon as our chairman and our head of our investment committee. Warren was head of the investment committee for Fisher Funds when they built their KiwiSaver scheme, and he kind of launched that for them. He was the head of the investment committee when they launched Generate KiwiSaver scheme.
Yeah.
Then sitting next to him, we've got David Moore.
Yeah.
David is 30 odd years trading floor at UBS in London, one of the smartest people you will ever meet.
Right.
And so it's actually the people involved, I think, is the most important because, as you say, you're trusting us to make the right decisions for you.
Yeah, that's right. And that's the people layer. And so when you look at the bank versus you guys, there's all this brand stuff that you almost need to dismantle.
Completely.
Because who are you trusting at the bank with your KiwiSaver fund management decisions, right? You're probably trusting an employee, I'm going to guess, or a group of employees, team of employees, and they're doing their jobs. They've got a little bit of skin in the game because they want to advance their careers. But when you're dealing with a smaller boutique or niche player, I guess in a sense, you have a little bit more skin in the game, don't you?
Oh, massively.
So you probably feel the weight of the decisions you're making way more Because you've got so much more to lose than any of your members do at this stage, right? Especially at the start
well,
phase.
put it this way, right? I go, so we've got 120 members, right? And we've got about
120 members.
120 members and $4.5 million of assets under management.
Just getting started, yeah.
So, yeah, it's just getting. But then in 3 months, it's been pretty good, right?
Yeah.
For me, I go, we feel massive responsibility of this because it's us, it's our friends, it's our family. Yeah. We probably know half the people personally that we've put into these funds and we're helping with.
Yeah.
And we will make sure we get it right for them.
Yeah.
And that's between David, Warren, me, the whole Hobson team, Anna.
Yeah.
There is such a personal responsibility here.
Yeah.
We won't fuck this up.
Yeah, that's right. And apart from your children, it probably keeps you up at night sometimes as well.
Probably more than my children.
Really? Okay, that says a lot. Based on what you were telling me before, that's a lot of time that you're not sleeping.
I don't sleep much.
Seems to be working though. So tell me, before we get on to kind of some of the current solutions and some of the current positive things that are happening in the KiwiSaver space, what are some of the other glaringly obvious problems with KiwiSaver right now?
So I'll go back to kind of the story. So the reason why we chose our model and what we saw was you still had 20% of people sitting in default funds. So that's a fund structure which was only meant to be a temporary parking lot for a couple of months.
Cash, fixed interest primarily.
Very low risk, not actually aimed at kind of helping people maximise their retirement, just enabling people to sit somewhere until they make a decision.
Yeah.
We then looked, next piece, we were like, okay, that's not very good. Let's kind of do a bit more research and figure out where people sit.
Yeah.
So then we went out and did a big survey of a whole lot of people. And we were shocked, right? We saw that less than 50% of people sit in a fund that matches their risk appetite and their objectives.
Less than 50%?
Less than 50%. So less than half of people have made a decision that works for them.
That kind of actually makes sense.
Which makes sense, right?
Yeah.
We then go, and then we go, okay, so why have they made those decisions? Well, they made those decisions because, scarily, the number one financial advisor for most people, Google.
Wow. And who knew that just having access to information doesn't necessarily lead to good outcomes?
Exactly. Exactly. So people say, when we ask them, where's the most important place you go to find information in your KiwiSaver?
Yeah.
They say Google.
Wow.
Then number 2 spot was banks.
Yeah.
And way down the list were the financial advisors.
Correct. Yeah.
But what was kind of scary is they were also inversely correlated, right? So you kind of people had talked to a financial advisor, had the better outcomes, all the way down to the people that had only talked to Google, had the worst financial outcomes. And so that was kind of, we thought, fuck, so we need to get people making better decisions, right? And to bring this to light, for the average Kiwi, you could sit in a default fund your whole life and contribute 3%, or you could make the right decisions about where you should be through your entire kind of life from the age of 30 to 65.
Yeah.
And it's exactly the same as contributing 3% versus 6%.
Wow.
So
really?
That's giving up an extra $30 a week of your income.
Yeah.
Just by making the right decision, right? So it's actually really, really important, and we need to get people making that.
Correct. Because these little tiny decisions around the edges has a massive impact, especially when you're using time, because time is just, it's not a linear thing, it's actually an exponential curve that's applied to that.
Exactly. The asset returns make it exponential.
Yeah.
And then we kind of kept on digging. And then we looked at, okay, well, let's look at KiwiSaver outcomes.
Yeah.
Because fundamentally, what's KiwiSaver for? People think it's for home, but it's not actually. It's there to save your retirement.
Yeah.
So we thought, okay, well, is it going to achieve its goals? And so then we did a whole lot of work around this, and we realised that actually most people only contribute 3%. That's matched by their employer, 3% as well.
Yeah.
So a total of 6%. That's only going to give someone an income of about 53% of their current income when they retire.
Gotcha. And thinking of what super is giving you in retirement.
Oh, that's including super.
Oh, that's including super. So it's only taking that, which is what, like 41 or something like that?
So that's about $300 a week coming from NZ Super.
Yeah.
And then an average person earning $80,000, they'll get about another $250 a week coming from
so it's less than half, like super is less than half of what the average income is, and this brings it up a little bit, but not much.
Yeah. It's kind of about, and then so you kind of go, no one's actually said this before, right? And then we go, but this can't be true. We've got the numbers wrong.
Yeah.
So we kind of checked the numbers, they were right. And we kind of did a whole lot of work. And then we went, okay, well, let's kind of have a think about this. Does this make sense?
Yeah.
And then we thought, well, actually it kind of does, right? Because when KiwiSaver was bought out, remember, we were meant to be stepping to 4 and 4.
Yeah, that's right. That's right.
But the kind of through the GFC, the national government decided, no, we will kind of just keep it at 3 to make it easier for employers.
Yeah.
We then looked at Australia and went, well, actually, they're moving to like 12 to 14% over time, which is actually what all of our modelling says you need to be.
Yeah, well, there's a reason why a lot of those countries are at least 10% plus, right?
Yeah. And so we were like, wow, this is really interesting.
Yeah.
So we've kind of seen the outcomes aren't going to deliver what people expect.
Yeah.
And from an international perspective, we're still way down kind of on contributions, and that all kind of starting to make sense.
Yeah.
But then what shocked us is no one was aware of this.
Right.
This is everyone, like, I think I'm probably, you and I, the first generation that will rely on KiwiSaver for our retirement, right?
Correct.
Because KiwiSaver has kind of been around for a decent chunk of our working lives.
Yeah.
Most of my friends go, no, I'm sorted. I'm doing it. I've ticked the box.
Yeah.
I'm contributing.
On to the next job.
I'm contributing my 3%.
Yeah.
Do I know what fund I'm in? No. Have I thought about it? No.
Have I reviewed it? No.
I'll deal with it later anyway. It doesn't matter because I don't get it till I'm 65.
Correct.
And then you tell them, well, actually, making the right decision on fund will make a kind of a huge difference. Yeah. Actually doing some work and thinking about contributions, because 3% is nowhere near enough, and they're like, no, 3% has to be enough.
Yeah.
That's what the government's telling me to do, so it's fine.
Yeah.
And no one's having these conversations with people.
So if the bank says this, if the government says that, if no one else is talking about it, I don't need to think about it. Is that kind of what you think happens in New Zealand?
That's exactly what's happening, right?
Yeah.
They're all going, no one's having this conversation, so therefore I don't need to have the conversation. And I think as a financial community, we've been a little bit remiss here as well.
Yeah.
So I remember having this conversation with a financial commentator, and that person said to me, yeah, but we can't scare people. Yeah. We all know it's there. But if we tell people they're only going to have 50% of their income, they're just going to go, well, what's the point in saving it all? So they give up.
Right. It's better they don't know.
Yeah. Exactly. There's a little bit of that there, right?
Yeah.
We don't want to scare people.
Yeah.
And
there's probably also a little bit of cynicism as well, right? Because, hey, you're making money out of this. We can't trust anything you say.
Yeah.
Is that a little bit of that?
Oh, there's definitely cynicism, right? And the hardest thing, I think, as a KiwiSaver provider, we have an obligation to provide education and help to our members. Yeah. But I think what everyone has found is that's extremely hard to do. Because KiwiSavers are not engaged, they're very apathetic about they don't care. It's very hard to engage them, and it's very hard to have these conversations. But that's also, I think, been a nice excuse for us as an industry, to be blunt.
Yeah.
How people think that they're doing a great job of moving people out of default funds when they're hitting kind of 12% moving on an annual basis. Yeah. When it was set up, they were meant to be moving 100%.
Yeah.
But now we're thinking we're doing a great job at 12%.
Yeah. And it's sweet. We're going in the right direction, but hey, there's actually a lot more to do here.
Yeah. And so, I think these are the conversations we want to start, right?
Yeah.
And these are the conversations that we want to start as a digital advisor, in helping people understand the implications of their decision.
Yes.
Helping people make better financial decisions,
yeah,
so that they get the retirement they deserve.
Got it.
The retirement they deserve and they expect.
Got it.
Because I don't think it's fair that we are telling people tick the box and contribute, knowing it's not going to give them what they expect, and not telling them that it's not going to give them what they expect.
Okay. And I guess being a startup, you have a lot less to lose by telling the story. Right? So I guess in a sense, what we're talking about in this room is not necessarily what you're going to hear from some of the larger, more established players, because why? Where's the incentive
exactly
to do so, right?
And I think there doesn't seem to be the incentive. And it's also the ways in which you communicate. I mean, banks, I think in particular, have now tied themselves up in knots around how they're allowed to communicate with the compliance. The banks I kind of understand, because unfortunately the banks are kind of the whipping boy.
Yeah.
And no matter what they say, they're always going to get kind of slammed. So you kind of, I do understand that, and saying that, that's no excuse not to try.
That's right. Yeah, well, and I think a closer working relationship, like regulator multiplied by private sector rather than regulator and private sector kind of just doing their own thing. Yeah. If there was an infusion, just like, tech can be infused with what we do, and we'll hopefully talk to that in a second, there's an incredible multiplier effect that goes on. But I don't know why we have to stay in separate lanes. Why can't we be working together here, right?
It all needs to, right? And I think what I do think is really interesting, who I thought did a really good job of this, was the Electricity Authority.
Right. Okay.
I thought the Electricity Authority did a really good job. I don't know if you remember the What's My Number campaigns.
Oh, yeah, I do actually, yeah.
They did an exceptional job at taking the charge on educating and kind of engaging with the media and pushing people to make better decisions around their power bills. Right. It's a simpler topic, don't get me wrong. It's a much simpler topic.
Yeah.
Where it's kind of money is the only thing that matters there.
Yes.
But I just thought it was a really interesting example of a regulator going, you know what, I'm going to deal to this.
That's great. Leadership. Well, it's leadership.
Yeah.
And in a lot of areas, there's a vacuum right now, and it's being filled with all sorts of stuff.
Yeah.
But because there's no leadership, there's no one actually standing up. I don't know if we're going to get too much further, right? We need someone to stand up and say, hey, this is what we're going to do.
And I think so. But I think, look, the one thing, there is the positive piece is, and I'll be curious to see how this rolls out, but we do have, for this year, end of March 31, an annual KiwiSaver statements. Right. For this first time ever, they need to have projections on them.
Right.
And so they need to have projections on them, which will be, this is how much you can expect to have in your KiwiSaver account when you retire. Yeah. But more importantly, this is what it will give you from a weekly income.
Perfect.
So for the first time ever, people are going to be able to see, actually, oh wow, that's only going to give me $200 a week. How am I going to live on my $200?
That's awesome. So often when you are looking to set up a KiwiSaver fund, you can have a look at that cool graph that shows, right, if I was in growth, it's going to be this amount, balance that amount, conservative that amount, but it just expresses it usually as a lump sum net of fees. But what you're saying is that there's a mandate now to show what
income, weekly income.
So
because a lump sum is pointless. You turn around to me and go, "You're gonna have $1 million when you go 65." I go, "Awesome,
sweet," because we have no concept of time.
What does that mean to me, right?
Yeah.
If you turn around and say to me, "You're gonna have $300 a week from the age of 65 to 95 to live on in today's money," I go, "Fuck."
Yeah. And that you should have that response.
Yeah.
And then you should actually start to think. And so hopefully that will encourage members to think. Will it have comparisons? Like, does it actually have to show what the value would be if they change their fund?
No. So
it's just what they're currently
it's just
on,
what
right?
they're currently on. And I think we at Koura, we don't think that's necessarily the right approach either.
Right.
Because I think for you, Darcy, saving for your retirement, you're probably sitting in a growth fund today. Yeah. But at 55, you should not be in a growth fund.
Yeah.
And there isn't any provision in those forecasts for having it tail off towards the end.
Right.
And the way the forecasts have been constructed means the 55-year-old looks technically as though they're going to be better off in a growth fund than in a balanced fund.
I see.
Because that's going to deliver the higher return.
Gotcha.
But it doesn't take into account the risk elements.
Gotcha. And the key word is projection.
Yeah, exactly.
Not a guarantee.
But look, it's going to be awesome to see, because hopefully we start the conversation.
Yeah. And that'll be net of fees, presumably, as well.
All net of fees.
Which removes that whole kind of, does it really matter what the fee is as long as there's performance?
Yeah.
To a certain extent. So that's another conversation.
That's a different conversation. So it's kind of, so I'm really excited about that. And I think that's going to be a game changer, right? The trick is actually getting people to look at their statements.
Correct.
Which will be, and that's where I think the providers, if they want to be brave, they will make a song and dance out of this.
Yeah.
And they'll go to their customer base and saying, "Hey, Darcy, you've now got your members' statement sitting in your portal. Make sure you go have a look. It's got this number on it. Make sure you think about it. Make sure you kind of do something about it."
Correct.
So if they're brave, that's what they'll do.
Yeah.
And I really hope they do.
And that's not actually that hard.
As a challenger, as a new business, we look at it as this is just another awesome excuse to engage with our customer base and help them get great customer outcomes.
Gotcha.
Talking to someone who's worked 15 years in financial organisations and worked with a number of big banks overseas.
Yeah.
For many organisations, and this is changing, to give them credit, but the number one rule was for a very long time, you don't want to talk to the customer because you don't want the customer to know that you're there. but
That's nuts.
No, but it's true, right? You kind of go, whether it be banking, insurance,
True.
a lot of the stuff and investment products, a lot of it is just recurring revenue, right?
Correct. Yeah.
Where
it's rent seeking.
No decision is ever needed.
Yeah.
And kind of one of the things you don't want to do is make them realise they're giving you a whole lot of money.
Correct.
Because then they're going to do a whole lot of research.
Correct.
And so for a lot of these, like all of these financial products are the same, right? They'll have decent churn in the first year or two as people kind of think about making better financial decisions for themselves. And this goes for insurance, it goes for current accounts, term deposits, it goes for investment products. It's all the same. But then if you can get a customer that's been there 3 or 4 years, they've forgotten about it.
Right.
And so the prevailing mentality for a long time has been, that's great. If they've forgotten about it, we don't actually want to disrupt that thinking because we don't want to get them back into the research phase and get them to start looking at it again.
Because they'll look at all their options, which may or may not include ours.
Yeah, exactly.
I get that. So what's the solution to that, right?
Well, hopefully the conduct reviews the FMA are doing will put an end to that kind of behaviour.
Yeah.
But I think, and look, I do think organisations are growing up and becoming more aware and smarter on a lot of this stuff as well.
Yeah.
But it's just interesting, right? Because it means that it is not a given.
Yeah.
That people will be wanting to use any excuse they can to engage with their customer base.
Yeah. That's insane. That's crazy. Yeah. Okay, so Rupert, we've kind of discovered and explored KiwiSaver. What is the problem? And to be honest, and I'm sure there's a lot more to it, right? But to assume that, hey, KiwiSaver is just amazing and it's going so well because of the balance increasing and because more members signing up and all that sort of stuff, that it's a little bit naive, because when you scratch a little bit, so far what I've learned here is that there's probably a few fundamental issues that are persisting that need to be addressed. Is there any more that you want to add to that before we finish up on this today?
No, look, I think it's getting people to understand that KiwiSaver is an investment.
Yeah.
And KiwiSaver is an investment that they need to actively manage and make decisions on.
It's not a savings product.
It is not a term deposit.
Yeah.
It's not a just put it in your bank and leave it there.
Yeah.
It's a product where you need to think about and at least every year have a look at and go, is it going to achieve the objectives that I want it to achieve? Are the settings that I have it at the fund choice? Are they currently the right fund? Is there something I need to be doing different?
Awesome.
And look, we say to everyone, do that every single year. Sometimes you might want to do it slightly less frequently, every couple of years.
Yeah.
But it is definitely not the set and forget product that 95% of people think that it is.
Awesome. Well said. And we'll pick up on that next week.
Cool.
So thanks again for coming in, Rupert. Really appreciate your time.
Thank you, Darcy. Nice
Cheers.
to meet you.
Thank you.